On to West Africa now. The economy of Nigeria is about 30% larger than previously estimated. That comes after statistics authorities rebased the economy. Effectively, they changed the way they calculate gross domestic product and incorporated new sectors into their calculations. Now, GDP at current prices stands at $243 billion in 2024 compared to the IMF's forecast of around $187.6 billion after the base year for calculating the figure was shifted to 2019. Now, what does that then also imply with respect to a bunch of other things? Well, Nigeria's debt to GDP ratio was 52% before the model change. Now it stands at around 40%. That's roughly the same level as the government's self-imposed 40% mark and below the 55% level that is encouraged by the IMF and the World Bank as a sort of target for countries to be able to meet. In the wake of that rebasing, Nigeria's economy remains the fourth largest on the continent, behind South Africa, which is around $400 billion, Egypt close by, and Algeria. At the same time, Nigeria's central bank was also holding its rate-setting meeting. It wrapped that up earlier today. It left the monetary policy rate unchanged at 27.5% for the third consecutive time this year. Now, the government pledged on Tuesday to maintain that rate until inflation risks recede. Consumer inflation in the oil-producing West African state fell for the third consecutive month in June to 22% year-on-year from 23% or close to it in May. The central bank governor, Olayemi Cardoso, acknowledged that inflation is easing. He says the rate-setting Monetary Policy Committee's decision was based on the need to sustain that disinflation momentum. Price pressures have been spurred by President Bola Tinubu's economic reforms ever since he got into office in the middle of 2023, and that included ending costly subsidies but also devaluing the naira to let it more accurately find its value in the open market. All right, then let's dig into the details of those two issues we've covered. Basil Abia is a policy analyst and a co-founder at Veriv Africa. It's a data analysis firm. Is joining us now live on the program from Abuja. Basil, good to have you on the program tonight. Let's start with what the governor said a little earlier today. I'm going to quote his words here for you. Monetary policy will need to maintain its current stance until risks to inflation recede sufficiently. But what's the data that the MPC needs to be looking at to then say, OK, we think monetary policy has worked here, we can now start a rate cutting cycle?
Yeah, thank you, Rama. The two data sets that the Monetary Policy Committee will have to look at and continue to observe are, of course, the money supply levels, and then secondly, both the headline inflation rates and the food inflation rates. Now, let's go back to the money supply rates. The money supply levels are significantly high. They're currently at 119 trillion naira. Even though it was a reduction from the April numbers just by a number of billion nairas, when you compare it with last year, this time last year, it was at 90 trillion naira. So that 19.9% hike in money supply levels will continue to put pressure structurally on our price levels in the macroeconomy. Now, secondly, yes, headline inflation rate has been receding, same as food inflation rate. It has not reduced significantly to the levels where I think the Monetary Policy Committee of the Central Bank of Nigeria think, okay, you know what, it's good enough to now start reducing the monetary policy rates. As you know, of course, this is the seventh time that they are sticking with the 27.5% rate. And the major reason is that headline inflation and food inflation hasn't reduced significantly. The last data by the National Bureau of Statistics put it at 22.22%, a further reduction from the earlier rate at 22.9%.
Right.
But that reduction is not enough for the Central Bank of Nigeria to want to start reducing interest rates.
Looking at the annual number, the annual print for inflation, there was this interesting decline of around 400 basis points in core inflation, right? Stripping out food, stripping out energy costs on an annual basis in June. Does that tell us that this monetary policy stance is working, or is that more a reflection of the weak consumer demand and the decline in disposable income in Nigeria?
I think it's a combination of a number of factors. First and foremost, market food prices and gate food prices are reducing, and they're reducing significantly. My company, Veriv Africa, we have been in the market observing for price changes in food from both market price and gate level prices since January this year. And I can tell you for a fact that the food prices are definitely reducing. Now, outside of the food price level engagement, that proportion, There's also another important proportion, downstream energy sector, especially for premium motor spirit, which is a very important product, especially when it comes to logistics in Nigeria, knowing that the World Bank has already reported 90% of vehicular and people movement are borne by our roads, and our roads have to be powered by vehicles that are powered by PMS. So PMS prices have reduced significantly from the 1,100 naira per litre rate to over 800 to 900, still hovering between 800 to 900 per litre. And that's largely because of the investments that Dangote has made with his refinery. And as you know, of course, he's spending a significant amount of money, over, if I'm not mistaken, billions of naira. I've actually forgotten the actual numbers, but I know that he's has already mentioned that he will spend monies to buy over 4,000 trucks, both for CNG and PMS downstream logistics. So that will further reduce the price pressures when it comes to PMS. And then outside of it, of course, there's also weaker consumer demand. So I agree with the point that weaker consumer demand is why headline inflation year on year has reduced. But there are other factors: stabilization of the naira, especially in the foreign exchange rate. More capital inflow has also increased our capital buffer. Right. The Central Bank of Nigeria just announced that our foreign exchange reserves have hit over $40 billion. So all of these numbers combined together give us the reason why headline inflation has reduced year on year.
Looking at the GDP data, what also stood out for me was the agriculture sector, right? Pretty much flat on an annual basis compared to the 1.79% contraction in the first quarter of 2024. Nigeria has the labor, it's got the water, it's got the land. What's holding back agricultural output?
It's a combination of other factors, but the first and most important factor is the high level of insecurity. The core crop production areas in Nigeria are in North Central and the Northwest, as well as the Northeast. And as you know, there is a combination of insecurity happening in those areas. In the Northeast, Boko Haram, especially the Islamic State in the Sahel and West African province, are really debilitating a lot of the farming activities there. There have been reports of farmers and fishermen having to pay high level of taxes to ISWA. So that double taxation, when you're also paying to local authorities as well, combines to increase the level of which these farmers and these fishermen will not want to go to the farms. In the North Central, it's even far worse. Let me even give you a very striking data point. Since 2023, when President Bola Ahmed Tinubu took over office, till date, we have recorded over 10,000 deaths caused by varying causative factors that are within the terror network. So terrorists, bandits, ethnocentric militia fighting has caused that. And the bulk of those fatalities were recorded by two states in the North Central, Benue State and Plateau State. Benue State recording over 6,000 deaths, Plateau State recording the remaining 2,000 deaths, and then the remainder, of course, crisscrossing the Northwest. Don't forget, in that data set, there is no data from Borno State because they could not calculate the Borno numbers due to the heightened insecurity. So insecurity is the core factor for why agricultural output hasn't increased. But there's also the science with which we do our agriculture in Nigeria. It's heavily non-mechanized. Over 95% of agricultural activity in Nigeria is carried out by rural farmers that do not use any form of mechanization whatsoever. So we have a tractorization deficit, and that has forced the government to start to look towards Belarus and Brazil for importation of subsidized levels of tractors. But even outside of that, the way we farm, our seed spacing, for instance, has ensured that we have very low yields compared to our sub-Saharan African peers. And our company, the Veriv Africa, has calculated that in a report called the Food Price Survey Report, where if you read it, you see why agricultural output hasn't really increased, and the aforementioned factors are the reasons why.
Indeed, and just looking at some of the available inflation data for some of the states on a state-by-state breakdown, the regions you're talking about, we're looking at food inflation rates of 30, 40%. So the numbers here, frankly, are quite staggering. One last question for you with respect to real estate. The sector is now, in terms of GDP share, it's bigger than the oil sector based on the data that NBS put out a little earlier. But the country still has an enormous housing shortage. So other than income constraints, which you've covered, the cost of credit, what else is stopping Nigeria from building the over 700,000 housing units that the market is estimated to need every year?
Yeah, the reason why I'm smiling is because there's a very powerful Nigerian who Africa is really proud of, but indirectly you can also say he's the reason why we have very high housing shortage. And there's data there. Academic journals have repeatedly released reports and academic papers looking into that. It's the high cost of cement. And it's because Nigeria's cement industry has very high barrier entry and has an emerging oligopoly controlled by three major cement companies: Dangote Industries, Dangote Cement, obviously, the Bois Cement, and then, of course, the international investors from France, Lafarge Cement. But the chunk of the market share is still dominated by Dangote Cement, and the prices continue to increase. 2-3 years ago, it was around 8,000 naira. In fact, at some point in some states, around 7,000 naira per 50 kilograms bag of cement. It's now hovering between 11 to 12,000 naira per 50 kg bags in certain parts of Nigeria, even higher in parts like Abuja, the capital, and then, of course, Lagos, because of the high construction intensity in those areas. So high cement prices obviously transmits into higher construction costs, but you also have a liquidity crunch because of the credit access constraints. So when you combine all of this, it's very hard even for state and the federal government to build these houses. However, I'm not going to use these factors to absolve our government officials from the blame. They have just not put in the work. They have not showed seriousness whatsoever. They haven't been innovative with their financing. Let me share this very important historical context. Since 1983, when the state governor then of Lagos State, Kayode Lateef Jokonde, was the governor of Lagos State and built over 30,000 housing units between 1979 to 1983 in Lagos. No government official has built that amount of housing units whatsoever. It doesn't even matter whether it was in 9 years or in 10 years or in 4 years. No one has attempted to build 30,000 housing units since then. That's how poor governance is when it comes to housing, especially engineering mechanisms for affordable housing. So governance actors have to put in the work. They've not showed the seriousness. And there's available liquidity if they're creative enough. You know, there's naira liquidity that is now provided by the Africa Finance Corporation to Nigerian subnationals. And unfortunately, we're not seeing state governors and federal government officials take advantage of these.
Indeed, plenty of food for thought there. Thank you for that. That's Basil Abia, a policy analyst and a co-founder of Veriv Africa, joining us there live from Abuja.